The building materials industry is currently navigating a cyclical trough. Across North America, manufacturers are seeing demand freeze and pandemic-era profits evaporate. In 2022, Boise Cascade generated $21.56 per share. Recently, that fell to 50 cents. Operating margins dropped to 1.9%. Free cash flow crossed into negative territory. Yet the stock price remains resilient near $66. The immediate drain on hash is driven by negative operating leverage. Boise Cascade operates 38 distribution centers and multiple manufacturing mills. These fixed costs persist regardless of whether housing starts are rising or falling. Management is treating this financial downturn as a period of deliberate capital reallocation. They focus on three specific levers: modernizing manufacturing assets, reducing the total share float, and shifting to higher-margin goods. This is a deliberate structural setup designed to rapidly accelerate per-share earnings growth when the macroeconomic cycle eventually turns. Boise Cascade operates as a vertically integrated entity. It begins with the wood product segment, which manufactures commodity materials like plywood and lumber. Replicating a logistics footprint of this scale would require years of development and substantial operating losses. The BMD segment acts as a margin floor, providing liquidity to maintain operations, while the cyclical manufacturing arm waits for a recovery in commodity pricing. Historically, Boise Cascade maintained a net cash-positive balance sheet. At the end of 2025, they held $477 million in cash against $450 million in debt. That position changed quickly. In one quarter, the cash balance dropped to $339 million, creating a net debt position. The largest driver of this decline was $65.5 million in share repurchases, alongside CapEx and dividends. Management is continuing an aggressive buyback program despite free cash flow turning negative. This chart shows the result, a 10.5% reduction in total shares outstanding over the last 2 years. With low stock-based compensation, this represents a genuine reduction in the equity base, not just offsetting dilution. There is a clear trade-off. By draining cash reserves to retire shares while earnings are depressed, the company reduces its financial margin for error. The goal is to maximize the per-share value of future earnings by concentrating the ownership of the company before a recovery begins. During this period of low demand, the company has heavily invested in modernizing its production lines, such as the recently completed Oakdale mill upgrades. This chart shows the resulting investment peak. In FY 2025, capital expenditures reached $275 million. This investment cycle has lowered the average age of the company's equipment to approximately 7 years, well within its useful life. Now that these major projects are commissioned, management is guiding for a sharp decline in capital spending to between $150 and $170 million in FY 2026. This step down in required spending is expected to unlock over $100 million in annual cash. Reducing capital intensity at this stage of the cycle structurally lowers the company's break-even cost. Unlike a lumber price recovery, this cash flow improvement is purely mechanical. It's the direct result of moving from an investment to an operational phase. These improvements are balanced by significant risks. The company recently pleaded guilty to felony violations of the Lacey Act involving illegally trafficked timber. While the fine is manageable, the company faces 5 years of federal probation and a mandatory supply chain overhaul, which may increase future sourcing costs. Additionally, Boise Cascade does not use derivative hedges for its commodity products. This leaves their earnings entirely exposed to fluctuations in lumber and plywood pricing. Ultimately, demand for these commodity materials is fundamentally linked to the health of single-family housing starts across the broader North American construction market. Currently, housing starts are trending lower, largely due to a mortgage rate environment that has remained in the 6 to 7% range. While internal costs and share count are optimized, the timing of a recovery remains entirely dependent on federal interest rate policy and broader housing demand. Boise Cascade operates in a cyclical trough, with macro restraints acting as a heavy weight. But internal mechanics have altered. Reduced CapEx removes $100 million in annual costs. Modernized assets process volumes more efficiently, and 10.5% fewer shares concentrates the eventual profits. When revenue returns to historical norms, That volume hits a modernized cost structure and a significantly smaller pool of shares. This is the core cyclical value thesis, using a downturn to consolidate and modernize, positioning the company for the eventual cycle reversion. Boise Cascade has assembled the internal components for a recovery. Whether this translates into a significant payout depends on the macro housing market stabilizing before the company's remaining cash reserves are depleted.